Hi, good afternoon, everyone. It's great, seeing Jay again. We haven't seen each other in 3 weeks, because I was traveling last week and there were elections in Brazil. So we're going to start today, and I would like to ask Jay, what he means about two-sided market.
Thank you, Roberto, and yeah, great to see you again as well. So that was the title of Friday's Musings, two-sided markets, and it really is an outgrowth of our monthly, now 2 weeks ago, which was titled Extrapolation and Beyond. And in the monthly, we highlighted that investors have really been extrapolating recent trends, whether they be inflation rate or central bank response, or the financial markets response to the central bank's response to inflation. It's really been an extrapolation game, right? And that's worked because inflation has consistently been higher than consensus. Fed has been overly aggressive with 3 75 basis point rate hikes, where it was very unusual prior to this cycle for the Fed to raise even once 75 basis points. Here, they've raised 3 times in a row. And then, of course, financial markets reaction to that having been pretty uniformly negative and disappointing. And so that was extrapolation. And then we talk about beyond, where we ask the question, okay, is it going to be a good thing to continue to extrapolate? And we would argue that no, we think we're coming up to the period where it's going to be a mistake to extrapolate, because we think we're coming to the end of a number of these specific trends, be it higher inflation, be it more aggressive Fed, be it more negative financial market action, be it a strong dollar. I think those 4 things are probably in the early stages of reversal. And so we noted in the musings, the two-sided markets, what just a whiff of better data would do, right? We had the JOLTS report. We didn't talk last week, but last week was the jobs report, and before that, the JOLT report. And the JOLT report was better than expected, and that's a data point the Fed looks at, job openings per unemployed, and it went from 1.97 to 1.67, still elevated, but down significantly, and suggesting it's rolled over. And so we had the best 2-day start to a fourth quarter ever for the S&P as a result. And that, I think, really syncs up with this idea of a two-sided market. We have been pretty much all one side, higher inflation, more aggressive Fed, weaker financial assets. Now the taste of how markets might react to better than expected data. And I think that's where, so we're now at a two-sided market, which I think means investors have to be increasingly open to the idea of a reversal in some of these trends and start to think about positioning for them. Now, granted, that positioning on days, the last couple of days where we gave back pretty much all that 2-day 6% move was given back between the remaining 3 days of last week and the first 2 days of this week. But on par, I think we're at a point where we're moving out of the kind of, if you were extrapolating, an easy period where you could just keep extrapolating. Now I think it's getting a little tougher, and investors should be starting to be more open to the idea of a two-sided market, open to the idea that some of these trends are about to reverse or end. And it's going to be a question of how aggressive that reversal is. And so what we mean by two-sided markets, and I think we got a taste of it at the beginning of last week with that 6% move in 2 days. You got a taste of it with Brazil with the first round results, and I think EWZ was up 9% in 1 day. So markets are all, positioning is all one-sided. Sentiment is really bearish. People are very short. And so all the kindling, all the dry wood, I just spent the weekend up in New Hampshire in the mountains, hiking and climbing with some friends and family. And the kindling, to start that fire when it gets cold at night, the kindling is there for markets to go to move aggressively. And the last thing I'd say on this is, to keep an idea in mind, the two-sided nature of things, there's been plenty of talk for months and months and months and months about, we got to go to 3,200. We have to go to 3,000. The Elliott Wave people are out there saying 2,500 or 2,200 on the S&P. So, I mean, that's the bearish talk consistently. Let's be two-sided, and let's look at, for example, the Stock Traders Almanac, which points out that the current cycle, midterm year, year ending in 2, et cetera, is lining up perfectly for what potentially could be, in their mind, a 20% move to the upside between now and year end. Think about the McClellan oscillator, which is one of the best known technical analyses for oversold markets. The most oversold it's been since the pandemic low in March of 2020. We all know what happened after that. And then note that the FinTwit world in Twitter points out that October has been the bottom for more major bear markets than any other month. We've had 9 bear markets bottom in October over the past history. The next closest month is March, when I think there were 4 bear market bottoms in March. So again, in the idea of being open-ended and two-handed, it's worth thinking that cycle-wise, and it's not just the Stock Traders Almanac, the Ned Davis research cycle, same thing, lines up with a pretty significant potential rally between now and year end, with very limited downside from where the market is currently. So I think bottom line, be open-minded to both good news and bad news.
Yeah, no, this is great. And can we actually go through some of the charts that you posted on the monthly, given we didn't speak last week? So chart 2, it talks about the PPI, what's happening there, and maybe it's peaking. And I would also like to ask you, I mean, I saw an interesting chart today, which says that China PPI normally leads the US PPI. So do you think, inflation-wise, could we have some help from China?
Well, first let's talk about chart 2, and thank you for referencing charts. We do a lot of work to pick really good charts for the monthly, as I think we've touched on. But for your audience, in this case, we look at TPW Advisory at probably more than 1,000 different charts over the course of a month. And we pick out typically the most compelling ones over the course of the month, and we put them in what we call a chart book, in a file. And that typically runs to about 200 charts. So out of the 1,000, we pick 200. As we write the monthly, we then pick the charts that are most in line, in sync with what we're writing for that particular monthly. And in this case, 2 weeks ago, we pulled 25 charts. So start with 1,000, get to 200, pick the best 25 out of that 200. And by the way, those 25 came from 16 different research sources. And so one of the things that is the benefit of an independent advisory firm like TPW is that we're not beholden to just our own work. We can pick and choose from all different sources all around the world, and many of whom I've known for years and have worked with for years at Morgan Stanley and elsewhere. And so chart 2 is a chart of CPI, global CPI from JP Morgan, and it just highlights that global CPI has come in dramatically and is going to continue to come in. So as an illustration, global CPI in the first half of the year was running between 8 and 10% on a global basis. In the third and fourth quarter, JP Morgan posits it's going to be between 4 and 5%. So globally, inflation has already halved and is probably going to continue to decline. Now, as far as China is concerned, China, and we've made this point repeatedly, to us, China does not, and not to us, but in general, China does not have the same inflation issue, nor does Japan. And so there's a desynchronized nature to the global economy and monetary policy, where the Fed and the ECB are raising rates aggressively, But the other two major central banks, the Bank of Japan, which is doing nothing, standing pat, and the PBOC of China, cutting rates, is in a very different cycle. And similarly, when you think about the global expansion, global economic activity, while the US and Europe may be slowing, and it's almost hard to say the US is slowing because Q3 growth, according to the Fed Now Tracker, is running at about 3% for Q3, which would be way above the first half of the year and would suggest that earnings in Q3 are probably going to be pretty decent. But nonetheless, let's say that US and Europe are slowing. Japan and China are accelerating, particularly Japan. You can argue about where China is in coming out of the COVID lockdowns. I think the second half of the year growth in China will be considerably better than first half, and that's why I say it's accelerating. But in the case of Japan, clearly the economy is picking up there. It's one of the few major developed economies with PMIs above C on a positive basis. Retail sales, housing activity, pretty much the whole lot of data points recently suggest Japan is accelerating. So Asia is in a different place than the U.S. and Europe, and that supports the global growth picture, which is in keeping with the times. You know, the IMF report came out today. Bloomberg, everywhere, the worst yet to come. That was the tagline that Bloomberg used to talk about the IMF report. Scary headline, Halloween type, spooky headline. Yet the reality, Roberto, the reality is that the IMF cut their global growth forecast for next year 0.2%, from 2.9 to 2.7. That's nothing. That's nothing. The worst is yet to come. And then a 0.2% reduction in the forecast. So this is the environment we're in, where blood sells, negativity sells, and everybody in the media, this massive media complex around the world, is pounding investors in the head with negative headlines like the worst is yet to come. And so most people just press sell as opposed to even looking at the story, which says growth is going to go from 2.9 to 2.7. That's a rounding error. That's like meaningless. So there you go. That's my rant. Yeah. I'll stay focused on the charts from now, but just so I make myself clear, I just think it's so ridiculous with these headlines.
No, I agree. And the next one is when it relates to what you just said, and that's chart 7, and that talks exactly about the high nominal growth environment, which is a point that we've been making for a long time, right?
Yep, absolutely. In fact, I referenced in the Musings J.P. Morgan's comments on that. So yes, we, as you know, and OHM Research clients know well, we've been talking for 6 months at least about a high nominal growth world, where high nominal growth of 6 or 8% is going to be supportive of earnings, because revenues, sales, and profits are denominated in nominal dollars. And so if you're growing your economy, as the U.S. has been, at 6 or 8%, a 4% earnings growth consensus, which is the consensus for, I believe, for Q3 in the U.S., about 4-5% earnings growth. That's not a high bar when nominal GDP is growing at 6 to 8%. And this was the point we made in Q2, and it proved to be correct in Q2, where earnings were better than expected. I think the same is going to be true in Q3 and beyond. And that was the chart. Again, that chart 7, was from FactSet, and it just shows that for the next 4 quarters, Q3, 4, and then 1 and 2 next year, the average consensus earnings expectations for the S&P range between 4 and 7%. Not a particularly high bar. But here's what J.P. Morgan literally wrote this week in their global macro outlook. Strong nominal GDP growth underpins equity fundamentals. Equities are proving to be an effective real asset class as their earnings are linked to inflation. Unless nominal GDP growth downshifts dramatically, earnings growth should remain resilient and defy expectations of a decline, even in an environment of low real GDP growth. I mean, we've been saying basically exactly the same thing for months and months. It's nice to see a big firm, a powerful firm like JP Morgan, come along behind little old TPW advisory and make the same points. But we think it's an important point, and it's one investors have just really struggled to grasp, in part because the negativity tone of the media, in part because from 2010 to 2020, pre-COVID, we were in a low nominal growth environment, right? We were in a disinflationary environment. We're now in a very different environment. We're in an environment of high nominal growth, more of an inflationary bias versus deflationary bias. I think that's good. When you take the zero interest rate policy in Europe and go from negative rates to positive rates, that is not a bad thing. Now, maybe going too fast is bad, and that's arguable, but we want to have high nominal rates or higher, above zero. It gives banks flexibility. It allows banks to make money. It allows central banks to have room to cut when they need to cut. And as we know, the market is already forecasting that the Fed will cut rates in the second half of next year. That may be the case, but it's much better for the central bank to have some buffer where it can move rates up and down than to be pinned at the zero bound.
At the low end,
and I think that's where investors have really struggled, because of the fact that for a decade we were out of the great financial crisis. We were in a low growth, low inflation environment. I believe, and maybe this is extending a bit too far, but importantly, and we've talked about this too, we believe that the next several years, not just the next couple of quarters, the next several years are going to be part of a high nominal growth world where the Fed will declare victory at inflation between 2% and 3%, because to go directly to 2 will cause too much damage. There was a great article in the FT by Martin Sandview making the case for why central banks should not destroy what he called the best jobs market in a generation for the Western world. Why central banks wanted to break that is hard to understand. But nonetheless, high nominal growth world, next 3 to 4 or 5 years, built on a global CapEx boom to deal with what we call the 3 C's of COVID, climate, and conflict. That's the world that we think we're moving into. We're not going back to the pre-COVID, low inflation, low nominal growth world, in our view.
Yeah, no, I agree. And actually, talking about that article, I saw Mohammed El-Arian. He retweeted that article today. You may have seen that.
Did he really? I did.
Yeah. Saying that central banks are risking destroying the best jobs market in a generation.
The article is good. I encourage people to take a look at it. Martin Sandview, he's an opinion writer for the FT. I think it was in yesterday's FT.
Yeah. And the other one I like, to mention, because it's very much related to what we're saying, is there's a lot of the leverage is quite low now, and when you said that blood cells and bad news cell, people are doing these overlay charts and comparing to Lehman and everything.
Yeah.
So leverage now is a lot lower, right? So by definition, it means that this should not happen.
Yeah, that was chart 11. Low leverage suggests low inflation risk, and that was provided by T. Rowe Price, and it just shows it compares leverage across a number of factors. Bank, corporate, and household leverage between March of 21, December of 07, and today. And in all 3 cases, bank, corporate, and household, leverage is much, much, much lower than it was in 07 and 08. And this, again, is it's just basic research, basic work. It's not hard to find. It's not hard to identify. We've made this point multiple times, that the consumer is in much better shape than they were in 07, 08, that banks are in much, much better shape. There's nowhere near the leverage. You remember that pre-Lehman, Goldman and Morgan Stanley were levered 30 to 40 times.
Yeah.
Now they're levered like 10 to 12 times. It's like not even the same game. And yet it's so ridiculous that everybody thinks we're going back to 08 was a disinflationary credit bust, right? We have an inflationary environment now where credit, by the way, is not signaling any concern. We pointed out in the musings, because we updated our model, and hopefully we can talk about that a little bit later on in the program here. But we referenced a high yield ETF that we have in our global multi-asset model, and it has been a great relative performer, in part because it hedges out the interest rate risk. So it's a pure credit risk instrument, right? And our view has been, with the high nominal growth, that we're not going to have a big, decline in growth or a big recession. We just don't think that's going to happen because of the high nominal growth. Therefore, we don't think we're going to have a lot of credit risk. And I think we did have a chart in here for sure. I just got to find which one it is, where it is. But we're making the point that there's not going to be a big default cycle, and that was actually chart 6. Credit outlook better than expected from Bloomberg. There's no default cycle, and so this high yield instrument, which hedges out the interest rate risk, which has been the big killer for bonds, obviously, because rates have backed up, is massively outperforming the traditional high yield HYG, massively outperforming the AGG, which is the benchmark for the fixed income space in the U.S., simply because there's not any credit risk. So the idea of an 08 happening just flies in the face of virtually anything you want to look at. But it sells, and people do the overlays, as you said, and the overlays look like they're in sync. And so people say we're going to have another Lehman. So Credit Suisse, another example. I think it's also very interesting for people to note, as we noted in the musings, that EUFN, which is the European Bank ETF, outperformed XLF, which is the US Bank ETF, over the last month during the Credit Suisse scare story, which again is another Halloween story. Over the weekend, some tweet or two comes out and it starts to snowball. There's there's virtually nothing to it. Yes, they may have to restructure, but Credit Suisse has been a problem bank for years and years.
Forever,
and years.
For years,
Yeah, there's not, 20 years. I mean, back when John Mack went and ran the bank for a while. I mean, it's just ludicrous. But I think it's important for investors to know that EUFN outperformed XLF during the whole Credit Suisse story. That is an important data point to understand where the appetite is, right? There's not even any selling pressure left because, as Bank of America has pointed out, European equity funds have seen net selling for something like 40 weeks. 40 weeks. There's not a whole lot to sell. Typically, if people held it and had gains and you had a Credit Suisse story, people would smash EUFN and retreat to other things. Instead, EUFN outperforms XLF. I mean, so I think this is what I'm seeing and what I'm saying about this two-sided nature of things and how the market is typical in a bear market. And this has been a bear market. It's been brutal. Believe me, I feel it. Our models have done okay relative to the benchmark, but on an absolute basis, they're definitely down for the year. So I feel that, but it's so typical of bear market type behavior, where the stories are scary and they come out over the weekend, and China coup and Credit Suisse failure and all these things. And yet you got to look at the action of the instruments that are at the center of it and see what does the price action tell you? And the price action tells me that in case of EUFN outperforming XLF, there's not a whole lot of sellers left in EUFN. And so arguably at half a times book with a net interest margin exploding as rates go from minus 50 bips on the 10-year bund to 2%. Banks are not going to make money in Europe. I mean,
Yeah, and finally, there's a chart before we move to the musings that I never forget to mention, and that is that the markets trust the Fed. So the implicit inflation. So I mean, I think the Fed should be looking at this more, or the market should be looking at this more. So why? I mean, why don't you think that people are still nervous and not looking so much at the implied inflation numbers?
That's a great question. I've been thinking they should be looking at them for some time, and it hasn't worked. So from your lips to God's ears, let's hope so. But yeah, that's chart 12, and that's from Fred. So the great source of all sorts of government data, and it just shows the 5-year break-even inflation rate, which is at the lowest it's been since early in mid 2021, at something on the order of about 3% inflation. And this is what the consumer surveys are showing. It's what the break-evens are showing. That this idea that the Fed has lost the plot and is behind the curve, and that high inflation expectations are going to be built into the wage discussion process, built into people's mindsets in terms of how they shop and buy things, et cetera, is just, again, there's nothing that could be further from the truth. Now, maybe it behooves the Fed to say these things to kind of keep a damper on things while they wait for inflation to definitively decline, right? Yeah. Certainly one of the issues has been, I mean, I think most inflation indicators have rolled over. They peaked back in the summer. The problem has been that the decline has been very slow. And you can look at, there's some difference between headline and core PCE, deflator, and the different things that the Fed watches. But one thing is clear is that inflation expectations have not become de-anchored. They're still right around 2 to 3%, whether you look at anything over a year. I think the 1 year is at 5%. Data just came out, the New York Fed survey on inflation, I think it just came out today. 5% on the 1 year, something like 3% and change on the 2 year, 2 to 3% on the 3 to 5 year. So it's all right in the traditional level, maybe above the 2%, which is why I think at some point the real discussion is going to be, declare victory as we get down towards 3% and accept this high nominal growth environment, because inflation expectations are anchored, because there's aggressive fiscal tightening. So it's not just monetary tightening. U.S. has aggressive fiscal tightening going on. And because of the secular disinflationary forces, which haven't disappeared, right? Technology, demographics, et cetera. Those have not disappeared. And so I think there will be a time when the case will be made that the Fed should declare victory at a higher level than 2%. And I've already mentioned this in prior writings, but people like Oliver Blanchard, who's the former chief economist of the World Bank, he's on this bandwagon. Jason Furman, who is Obama's head of the Council of Economic Advisors, he's on this bandwagon. And I think more people will become members of this view that the Fed should declare victory around 3% as we get closer to it. And that's where we are, certainly.
Okay. No, you talk a lot about data dependency, which is that's exactly what it is. So we have quite a few. We have had quite a few negative surprises on the inflation number, and even when there was not a negative surprise, there was you had the Fed boys, sometimes 2, 3, 4 of them speaking during the day, and trying to make sure that, okay, hold your horses, because we'll be as tough, we'll do whatever it takes. So I mean, why you think they're doing this, and you think they're just trying to manage expectations, and
Well, I think there's some job owning going on for sure. I think they do want to see a sharper decline. And I think that's right. I mean, we still have 8% inflation. So I get that. I mean, there's the issue of, the fact that rate work with a lag. That's well known, right? Typically 9 to 12 months. And the Fed has never been this aggressive. This is the most aggressive tightening cycle in modern Fed history. And so we're tightening super aggressively. And at some point, we need to start recognizing that we haven't even seen the real impact of these tightenings, given the traditional time lag. Now, one could argue with the modern rate of speed that time lag will be compressed, but it's not instantaneous, though it does look, when you look at housing, right? If you are worried about inflation right now, the transitory stuff is clearly rolled over. The commodities, the used cars, supply chains completely cleaned out. Now the issue is too much inventory. I can tell you for a fact that watching football on live TV, every other ad is a sale. A sale from Target, a sale from Kohl's, a sale from Home Depot, a sale from Walmart. All these guys are operating with tons of excess inventory. Nike, that story was in the news over the last week or so. So all of a sudden, we're getting the opposite. We're getting all these sales, and I think that's going to be the story going forward for the next couple months on the retail front. Is it's going to be a great time to be a buyer. Same thing on housing, right? Housing market has imploded. The decline in housing, I just saw a really great chart today, has been faster than during the great financial crisis. Now, that's not to suggest that there's going to be a bust like there was in 08, because the buyer base is in much better shape, and there's none of the zero down and all that stuff that happened in 06, 07, 08. There's none of that in today's housing market in the U.S. But nonetheless, the pace of decline in housing is more rapid than it was in 2007 and 2008. So that's clearly a segment of the economy. And we had a chart, I think it was chart 50. Rents are starting to roll over. They've clearly peaked in the United States, and that's a big chunk of the CPI that typically tends to be quite sticky. So the question is, and I'm sorry I got to it in kind of a long-winded way, but the question is, does the Fed see the action in the housing market, see the rents rolling over, see the job market, even though it's still pretty robust, clearly slowing, right? 263,000 jobs in September, down from an average of 440,000 jobs on a 6-month average basis. So clearly slowing. Does the Fed see that? And are they going at some point be willing to say, you know what, we think we want to like take our foot off the gas. We have the market is fully embraced our terminal rate of 4.6%. We have real rates now of 1.5%. We have the tightest financial conditions we've had in the U.S. since the great financial crisis. We have housing rolling over faster than it did in 2008. We're going to move from a 75 basis point pace to a 50 basis point pace to a 25 basis point pace to a pause. And I think all of that is coming in the next couple of months, next quarter or two. And that is need to be two-sided, because when that happens, markets are going to react aggressively. And again, as we've said for the last month or two, we think that's going to be the dollar in particular, rolling over and setting off the opportunity set in non-U.S. equities and emerging market equities, in emerging market local currency debt, in commodities, et cetera. And that's where we've been adding over the last couple of months. Arguably too early, yes, but when they're not going to ring a bell and say buy, or at least I don't ever seem to hear the bell. So I'm in a position And we're trying to position the TPW advisory, our models, to be ready and already in position when this happens, because we don't know when it's going to happen. It could be this month, it could be next month, but we've been waiting for the Fed to finish its aggressive front loading, the 75 basis points. We had thought it would have been last month. Maybe it's early in November. Maybe they do one more 75. I guess a lot will be determined CPI in a couple of days. But I certainly don't think, nor does the market really think, that there'll be any more 75 basis point hikes after November 2nd. So that's a step down. And then as we move forward, I think there's, the history of the last couple of years, COVID, commodity spikes, etc., has been sharp spike up and a quick collapse. Look at the natural gas market in Europe as an example. Spiked dramatically and then a massive collapse, down 60%. Dutch natural gas prices down 60% in the last month. And yet the European financial asset prices are lower. I mean, again, it doesn't really compute. The big fear, gets dismissed, and yet there's no reaction in the financial asset price environment, and that's bear market behavior. And when it changes, it's going to change fast, because you've got to recoup that differential. And so I think, again, long-winded. I guess I'm a little long-winded today, but the point is that there's, I think, room for inflation to come down much quicker than people think. And I know I've said that for a couple of months and it hasn't happened, but that doesn't mean it's not going to happen. And should it happen, the reaction in financial assets is going to be violent to the upside.
Yeah, that's what I was going to ask. I mean, tomorrow we have PPI, and then the CPI on Thursday. It looks like, from what you're saying, that the asymmetry in the data is quite positive, right?
I think so. And my point would be that the market is already on board with the Fed going to a rate of 0.6. We already have real rates as high as they've been in quite a while in the U.S., 1.5%. Financial conditions tightest they've been since the great financial crisis. So this is the point. Those last two data points, real rates and financial conditions, typically when they get to the point they're at today, the Fed is cutting, not hiking 75 basis points. And this is what's getting people a little freaked out, that maybe the Fed is like, hell-bent on a mission and is kind of disregarding its own historical knowledge about how its policy operates with a lag, and is going to, tighten too aggressively. Now, the offset to that is this high nominal growth environment where the economy is continuing to benefit from all the money that was injected into it during COVID. And that is particularly pertains to consumer savings, which is allowing the consumer to continue to consume while their real incomes are being reduced because of the high inflation. So there's a excess there that's allowing the economy to decelerate perhaps more slowly than one would think. But in essence, I believe that yes, at this point, the market has priced in an awful lot. It's hard to envision, given what we just talked about with the transitory inflation issues having rolled over, with housing completely rolling over, with the labor market slowing. It's hard to imagine that inflation will not continue on its downward trend. And then the question becomes, at what point, as I mentioned before, does the Fed say, you know what, we want to kind of chill out and assess what the most aggressive tightening cycle in our history, what it's going to do to the economy. We're gonna go to 25. We're gonna skip a meeting. We're gonna pause. Whatever the case may be, that's down the road. Right now, we just need to see some significant inflation reduction in the inflation numbers. And then also the understanding, as again we pointed out, that we're going from inflation rates at the beginning of the year, 0.6, 0.8 month over month gains, to inflation being 0.1% month over month. So that when you average out like say the last 3 months of 0.1 month over month, you get to a very low inflation number over 12 months, down from when you average out 0.8% month over month for a year, you get to 8 to 10% type inflation levels. And so we already have arguably decelerated dramatically on a month over month basis. And we've shown this before. If we continue at 0.1% or 0.2% month over month, by the time we get to March of 2023, inflation will be averaging, headline inflation will be averaging 3% per annum in the United States. And so that's why I'm saying the time is shrinking for this kind of two-sided market, and to move towards an understanding that we're entering a different regime insofar as the Fed activity level is going to be concerned. And that then sets up perhaps for a situation where for at least a quarter or two, the ECB may be the most aggressive central bank, which would then support the euro, which would help weaken the dollar. Because as we talked about a couple weeks ago, and we referenced again in our musings, the dollar has been stronger against the developed markets than it has been against the emerging market FX, which again is something that's quite unusual. When the Fed tightens aggressively, typically emerging markets crack. That has not happened this time on the FX side, in large part because they're floating currencies, unlike prior. I mean, I've even seen people start to talk about the Asian FX market being set up for another 1998 type implosion. I was in the markets in 1998. I did global emerging market strategy for Morgan Stanley. I was in Thailand in 1998 discussing this exact stuff. The currencies were fixed then, and they couldn't sustain them because they had borrowed too much in dollars, and they had to break the pegs. And that led to the, obviously collapses because they were artificial. Now currencies are floating. It's nothing like it was in 1998. And yet the people just reach for these easy things. Oh, crisis. When was the last crisis? Oh, 98. Okay, let's talk about how this is like 98 without the most basic of understandings. 98 fixed versus the dollar. 2022 floating against the dollar. Not the same thing, people.
Yeah, and can we talk a little bit about China? Of course, China has been dead. I mean, of course, they've been on holidays for a week. So I mean, what are you hearing there? I mean, there was also a chart on the monthly talking about high yield opportunities in credit in China. So what's your view? And you also have some conflicting statements, conflicting noise over the zero COVID policy. So what's your take there?
Yeah, well, we did have a chart. I'm just looking. We did have a chart 17, talking about China having a consumer confidence problem, where we showed the consumer confidence just falling off a cliff with the lockdowns. And it hasn't really recovered, right? And we talked about this before, but we have to appreciate the fact that less than 3 or 4 or 5 months ago, China and Beijing were completely locked down in ways that in the West, very few people were, and that's just less than 6 months ago. Whereas in New York, I mean, it was horrible back in March of 2020, in the spring of 2020, in the summer of 2020, but that 2 years ago now. So it's hard, it's hard to put ourselves back in that mindset of, deep in COVID as folks in Shanghai and Beijing were just a few short months ago. So that consumer confidence problem is weighing on Chinese economic activity. They've been able to kind of offset it with strong export growth. The question of will that export growth continue if the other rest of the world economy slow is a valid one. That's maybe why they're not all that upset if the yuan weakens a little bit against the dollar. Again, not going to crash. They control it. They have $3 trillion in reserves. They're not going to crash. They're happy with it devaluing a little bit. They don't have an inflation problem, so they can let it value, et cetera, et cetera. So I think really the issue for China, and again, talking about two-sided, in Bloomberg today, two separate articles. One saying how the People's Daily is saying that zero COVID policy must be maintained. The other arguing that China will relax the zero COVID policy post the People's Party Congress, which begins this Sunday and lasts for about a week. So again, pick which one you want to follow, which one you want to go with. I think my own view was that the article saying that economically speaking, China needs to make a move to ease the zero COVID policy makes a lot more sense to me. It points out, the article pointed out how the local governments are struggling because they don't have land sales, which is a big way that they make money because the property market is so weak. We've talked about how we believe China has drawn a line under the property market. We highlighted, as you mentioned, the Asia High Yield Fund, again, that we have in the global multi-asset model we run here at TBW Advisory, been a very strong relative performer, notwithstanding all the horror stories about property in China. We think the government understands they've had put in place 2 bailout packages to ensure that the properties that are bought off plan, right? So I'm sure you know what off plan is. They're buying based on like a rendering of what the apartment will look like. The developer takes the money, uses the money to build the flat, and then the people move in. What's happened is because the developers are struggling, they've taken the money over the last year or two and haven't built all the flats. The government is now stepping in with bailout packages to provide the money for the developers to finish the flats so that there's not social upheaval of people who are upset that they paid their money and they don't have the place to live. So that process should by itself give the economy a lift, because when you're building these apartments, you need your steel, your cement, your rebar, etc. You need your refrigerator, your couch, your chair, your desk, your table, etc., etc. And so I think that they already are moving off the stringency of the zero COVID that existed 6 months ago, right? The last big lockdown of a big city, rather, Chengdu, lasted only 2 weeks. In Shanghai was locked for over 2 months. So they've already gone from 2 months to 2 weeks. And they have opportunities to look at Hong Kong. They have opportunities to look at Vietnam. Vietnam could be interesting. And I take this directly from the Bloomberg article, pointed out that Vietnam had its big party Congress. And right after it, they eased their zero COVID approach. And the economy's been wide open subsequent to that. And COVID has not been a particular issue. So I think that it's reasonable to expect some easing. I don't think it's going to be like a bear headline, China does away with zero COVID. I think it's going to be much quieter, but I expect more support from China as we move forward. And I would just note that the IMF in this latest global growth forecast China to grow at 4.4% next year, whereas most people are at 3% or so this year. And we've talked about maybe a 4 to 5% growth rate for China in the second half of this year. Remember, back 6-9 months ago, their target for the full year was 5.5%. That's clearly not going to happen.
Yeah, and finally, any words on Europe? I mean, and of course, people are talking, mostly about the Fed, but of course, there's been some serious escalation in the war. I mean, of course, it's impossible to discount a nuclear war or nuclear threat. So, I mean, and it's also difficult, to have proper insights on that. So, what are you hearing on the war front?
Yeah, I'm not. I don't have any particular inside knowledge. I do think that there are ladders of escalation and policies and things that have to happen to lead to something even like a tactical nuclear weapon deployment. And none of that seems to have happened. And I'm sure we would be hearing about it as soon as it did happen. I mean, just the way the Twitter universe works, the way information works today, I don't think something like that would be hidden. I do think that the recent missile strikes on basic cities and civilians in Ukraine is a sign of weakness for Russia. It doesn't achieve anything. It may be, I don't think the Ukrainians are going to be scared by this. It's a waste in a way of very expensive military hardware. Each one of those missiles is quite expensive, and they're achieving nothing whatsoever in terms of a military objective. So I don't see that as being anything other than a sign of weakness. And there is talk that Russia has changed its commander, and the current commander has got a history of brutality against civilian targets.
Yeah.
But we've already suffered through that, and that's not going to be news in the Ukraine. I mean, I think the reality is that Russia is losing on the battlefield, losing in the economy, and losing in the energy space. I've referenced earlier the fact that energy prices, natural gas prices in Europe have gone down 60%. Spot electricity prices in Germany, likewise down 60%. I read just the other day that Germany is approaching 95% storage capacity being filled for natural gas, which was a number that people thought wouldn't ever be achieved. They're there. So the idea that Europe is going to suffer through a winter of rationing and people being cold in their homes and lights being shut off is already, complete fiction. Yet again, I go back to the point that financial assets have not responded at all to the fact that the storage is sufficient to carry them through the winter, that the price action of the fuel and of the electricity is reflecting that, but nothing else is. The euro isn't, European risk assets are not. And so to me, that suggests that, again, bear market mentality, and at some point the penny's going to drop and there's going to be pretty significant interest in Europe. To me, the latest important point is that there's now seems to be a level of agreement on joint debt issuance to offset the effect of the energy crisis. This is the same as what happened with COVID. This is the crucial stuff, right? I think Europe has kind of crossed the Rubicon of joint issuance, and that is very, very bullish, I think, for a European curve, right? A European fixed income curve like the Treasury market over time, not relying on the Bund market, which Germany traditionally doesn't borrow much, so it's completely illiquid. It's very bullish for the euro as a reserve currency because reserve managers can now buy fixed income, European-wide fixed income. So there's a lot, out of all the crisis, I would argue that there's an awful lot of positives on a strategic basis that are taking place in Europe. And I just wanted to note, because we did have one chart that I thought was pretty important. On chart 16, we show that Europe's fiscal impulse over the next couple of years, because of next gen, because of the Fit for 55, because of the effort to support consumers and businesses through the energy shock, there's going to be a lot more fiscal support in Europe than there is in the United States. And so Europe, while it may go into some sort of a mild recession, it's not going to be deep. It's not going to be dramatic, in part because the fiscal lever is being pulled aggressively, and it's being pulled jointly, which I think on a multi-year strategic basis, and I've said this before, and I'll say it again, I think over a 1, 3, 5 year basis, anybody with that kind of time frame buying European assets with the euro at under parity and European selling at 25-year low valuation discounts versus the U.S. with 40 weeks in a row of selling of European equity funds. I think if you've got any kind of stomach for near-term risk but long-term gain, Europe is a mighty attractive place to put money to work. That is obviously a minority view.
Yeah. No, I agree. And and finally, on last 4 minutes. Can you would like to talk about the reviews of the portfolio?
Wow, yeah, that's a fast hour, Roberto. You've been this has been good. I thought we would have another 15 or 20 minutes. Super. Yeah, we did do, as you know, we update our models every month. We do our musings every Friday. Then we bring that together and do a monthly at the end of every month, and we put all our thoughts together. We pull all those charts we mentioned at the top, and then we do our model portfolio review session. We look at the technicals of all our positions, plus some on our watch list for our two models, the global multi-asset and the TPW20, which is a 100% thematic model. And yeah, a couple of things stood out. I mean, one was that most everything got up to their 20-day moving average and then rolled over, suggesting that we need more catalysts to continue that push. Another real interesting point was that the majority of our holdings did not make new lows during September, which was obviously a pretty ugly month. And so that's kind of telling. And I think others have noted that as well, that while the indices did breach new lows, many stocks did not. And many ETFs that we hold in our models did not make new lows. And I think that's really, really important. There were very few overbought or oversold conditions. Everything's kind of sitting in that in-between land. There were a few exceptions, obviously the energy sector, where we've been big believers in overweight for a couple of years already, right? You and I have been talking for a long time. We were bullish energy from the beginning of the time we started talking, continue to be overweight. Energy is over its 200-day moving average. Brazil is over its 200-day moving average, really leading the emerging market charge. And so we didn't really make a lot of changes. In essence, we basically took a little bit off our healthcare position, which we've been using as a defensive position, and it's done quite well relative on that basis. And we put some money to work in emerging markets. To be clear, actually, we put it into Brazil. So we now have a pretty healthy overweight in EWZ. We continue to own local currency emerging market debt. We continue to own Asian high yield. We continue to own China, Southeast Asia, and Brazil. That's kind of our emerging market allocation. We're now overweight across assets. And we added to value in U.S., particularly in financials. I'm just struck by the lack of appetite for financials, even though the net interest margin at the big banks must be exploding, given how rates have backed up. And that's where that's the big money engine for the banks, the big consumer banks, is the net interest margin. You were a bank analyst. I think you'd concur. Yeah. And so people are worried about the investment banking revenue because there's no IPO market. Remember, we wrote months ago the time to invest versus the time to market. So we highlighted that 3 or 4 months ago. But to me, it's the net interest margin story is much, much bigger. The U.S. banks sell it now roughly 1x book. European banks sell it about half of book. Net interest margins are going up. We're not believers in a deep recession, so we're not believers in a big credit default story or a big provision story. So we like the financials, and we think there's an opportunity there. So we added there as well. And that was really the bulk of it. I mean, to be honest, we didn't feel the need to make dramatic changes. And so we continue to be overweight equities, deeply underweight sovereign fixed income, though it's getting a little bit more interesting, and overweight commodities, overweight non-U.S., overweight EM now, and looking for that turn in the dollar, turn in the Fed, turn in the dollar, and some of these extrapolation, these trends to start to reverse. And when they do, I think risk assets are going to respond very, very aggressively.
That's great. I agree. Let's hope. It's been, as usual, a great session. And let's speak. We'll see each other in 2 weeks.
Thanks, Roberto. Have a great night. Enjoy Brazil.
You too. Thank you, sir. Bye-bye.
Bye-bye.